Hey there, listeners. If you enjoy this podcast even half as much as we enjoy producing it, show your support by subscribing and leaving a review. It really helps us keep those dividend checks coming.
This is Greg Denweiler, and you're listening to another episode of the Dividend Mailbox, a monthly podcast about dividend growth. Our goal is to stuff your mailbox full of dividend checks and make each year's check larger than the last. Welcome to episode 20 of the Dividend Mailbox. In this episode, we're going to talk about a BDC or Business Development Corp, and specifically we're going to talk about Oaktree. This is unique because it has had dividend growth in the last several years, but it's not sustainable. We're really going to try to draw a hard line between what is sustainable dividend growth and what is not. Specifically in Oaktree and BDCs in general, it's virtually impossible for this thing to sustain dividend growth. It can't continue indefinitely just because of what they are and how they operate as businesses. But there's a second piece to these, which is one of the reasons why we're talking about it. They're great value plays if you buy them right. Not only can you make excellent money on these things just from a capital gain standpoint, but then you can also pick up great dividend income at the same time. You just can't confuse them and think that these are good buy and hold forevers, because they're not. And we're going to get into at what point are these things really worth looking at, and then why at this point it's probably time to start looking at selling them. And then finally, since fourth quarter earnings calls are pretty much over, we'll recap some of the companies that we've gone over in previous episodes and just give you an update on where we see the situations, where they're at, and what we continue to look at and what's important to us. So now let's get into Oaktree. And if you listen to episode 18, we really were extremely negative on buying high-yielding investments for dividend growth. And our definition of high yield, if you don't remember or haven't listened to it yet, was really anything over 5% to a degree, but especially when you start getting up to 7% and above, it's just you really have to be careful, and you have to understand that you are now in a different world than when you're just buying long-term dividend growth stories. Oaktree has a very attractive dividend yield. It is over 10%. So it's got a great income. And then on top of that, for the last several years, it's had a growing dividend. You may be asking, okay, why are you talking about this thing then? This just contradicts everything you just said. The difference is these are stories where you buy them cheap. You can get great value there. Doesn't happen that often, but the opportunities come up. But then there's the time when you got to start thinking about exiting, because these things are not long-term sustainable dividend growth stories. These are not companies that are growing earnings over time, but if you buy them right, you can make a lot of money in them. So for those of you that aren't familiar with a BDC, there are several companies out there. In this space, there is definitely the ones that are fairly well managed, they're good at allocating capital, and the ones that aren't. And some of the better ones are, well, we think Oaktree is one of the better ones. The symbol on it is OCSL. Then there's Hercules Capital, Ares Capital, Golub Capital. Those are some of the bigger names that have some track records and have had pretty good success at managing their portfolios. What a BDC does is it loans money out to what they call mid-market companies, is what most of them do. Wall Street looks at a middle market company sort of as one that's too small for a JP Morgan or Merrill Lynch, Bank of America, they don't really want to do a $100 million deal because it's not that big for them and they don't make that much money off of it. But it's kind of too big for a bank deal because they don't want that kind of risk out there without something as collateral. These are ongoing businesses and they're in all different kinds of industries. Most of the time, you don't just have a hard asset such as a piece of property or an apartment building that you can borrow against. So these BDCs basically specialize in filling the gap and loaning money to these companies. And most of the time, they're variable rate loans. So what happens here is Oaktree has a fund and it's got $2.6 billion in it. That's the total investment. Part of it is leveraged. Actually, about half of it or a little bit more. So they take the $2.6 billion and they loan it out. You look at the debt structure of Oaktree, they borrow money and then turn around and loan it out. Well, they get a spread, meaning they are investment grade rated. It's triple B or above. So they pay a lot less for their credit. And then they loan it out to companies that pay them more. So they earn the difference. We focused on Oaktree partly because they took over the management of this fund in 2016. Before that, it was really poorly managed. They were losing asset value over time. And Oaktree had a great opportunity to come in, take over the management of the portfolio. Basically, they bought the right to manage it. They sort of specialize in distressed debt and high yield situations. And they're a huge fund management company. And this is just one of the things in their portfolio. They've got a great track record of managing high yield and distressed debt. And so as I mentioned, about $2.6 billion portfolio, loaning the money out, total of 156 different companies in the portfolio. Loans are $25, $50, $100 million. 72% of the loans are first lien, meaning if the company defaults, they are one of the first in line to get paid. So that's a positive. Top 10 investments are 19% of the fund. The next 15 are 20%. And then the remaining roughly 130 of the companies represent about half the portfolio. So it's relatively diversified. 16% of the portfolio is software. IT services, 6%. Then it goes down to financial services, pharmaceuticals, biotech, healthcare, specialty retail is 3.8%. That helps spread the risk out. And if you look at one of these companies, you really should know as far as what the concentration of risk is, where it is it industry specific, and then another thing is leverage. The average yield in the portfolio right now is 11.6%. They have average new commitment is about $250 million. And right now, the average yield of new loans that they're making to these companies is 13%. The weighted average interest rate on Oaktree's debt is about 5.5%. While I just told you the rate that they're loaning money out currently is 13%. So they make a lot of money just on what they borrow. So that gives you just a quick idea of what they actually do. Back to dividend growth, which is the core of what we do for OCSL. Going back to 2016, the dividend was only 18 cents. Now it's up to 55 cents a quarter. So the dividend has grown by 20% a year. And now it yields almost 11%. So you definitely have dividend growth there. And part of it's because of management reinvesting capital. And part of it's just because interest rates have trended higher. And in addition to that, since they pay out all their income, you received a special dividend last quarter. So the yield in effect is even higher. Now, here's the really important thing to remember. And this is what makes these things at times really great value plays. Most BDCs trade as closed-end funds. The difference between a closed-end fund and a mutual fund is They issue a certain number of shares and it's fixed. They don't issue shares if more investors come in and put money in it. They don't sell shares if investors liquidate. So they can go to discounts or premiums. And, really the reason for that is because in a distressed situation, like in 2020, if they had to sell shares, then that means that they would have had to start selling part of their portfolios. And when you're in an environment where there's real distress and there's real panic, you can really almost wipe out an entire portfolio as these things just start to spiral down. More selling creates more selling. So if it's a closed-end fund, they don't have that risk of having to go in and sell part of their portfolio because investors are selling. If the market is down and investors are getting worried and they're starting to worry about, are these companies going to be able to pay off debt? Then what happens is these things will go to discounts and they can go to significant discounts up to 50% or more. You get a portfolio for half the cost of what it's actually worth. So in 2018, we first started buying Oaktree, and it was when the market was getting hit fairly hard. Oaktree was trading around 75% of its asset value. So it was trading at a somewhat significant discount. And the great thing about it is the assets are marked to market. So every quarter, what they're worth. The only thing that can change at that point is if one of the companies defaults or the market goes up or down, the asset value is going to change. But you know what it is at least once a quarter. If you buy a 55-cent dividend and you only have to pay 75% for it, that means your yield is starting to look fairly attractive. But in 2020, we bought it at two different prices. Right now, it's trading around $20 a share. We bought some at $11.85, and we bought some at $8.70. The discount in March of 2020 got down to 35 cents on the dollar. Well, right now, the net asset value of Oaktree is $19.63 a share, and at $20, that means it's at a slight premium, couple percent. So you can start to understand that if you can buy these things at steep discounts, you can make a lot of money in them. And as I've illustrated just in the last few years for us, it's been a really great value play. But this is a part of where I want to really get into why this thing is now a red flag for us, where we get into the difference of dividend growth versus sustainable dividend growth. And we're thinking about selling half of it, or depending on what it does here over the near term, maybe all of it. 85% of Oaktree's portfolio is variable. So every time the Fed raises the interest rate cost to these companies goes higher. And now they're up to between 11 and 13%. If you're getting that kind of a yield, you're taking risk. And the risk is becoming much higher than what the potential reward is. At this point, personally, I think there's very little dividend growth that's left in it. If you remember the podcast a few months ago, we went through what you have to look at is what that implied yield represents. CCC rated bonds yield about 13.5%. Single B rated bonds are yielding around 8.5%. So that basically implies that the new loans they are making, even though they're first lien loans, most all of them are, you've got relatively low credit ratings. And what the credit rating is, basically their ability to pay back and the likelihood of default. Well, when you're down in CCC over a 10-year period, likelihood of default is over 20%. So the likelihood of default over time is relatively high. And it's basically when we get the next recession is when it really starts to happen. Well, the problem is timing the market is extremely lucrative, but virtually nobody can do it. What you have to do is basically you have to decide that the upside in this thing just really isn't there anymore. And I'm not going to let this dividend yield seduce me into holding it. So looking at when I bought it at $8.70 in 2020, it was paying $1.14 in a dividend for the year. That's a 13% yield on your money. And over the next 3 years, the dividend has more than doubled. But what happened was interest rates were much lower in 2008, 9, 10, and in 2020, the 10-year Treasury got below 1%. You had these variable rate loans, which were much lower than they are now. There, you have dividend growth because as the short-term interest rates started to go up over time, and especially in the last year, what happens is the income to this portfolio is going up. Short-term interest rates go up, the cost of money goes up, which is why their rates are now up to 13%. Here's the deal. Basically, the dividend on this thing has probably capped because companies, it's going to be hard for them to be profitable when they're paying 13% for debt in this kind of an environment, especially if the economy slows down at all. Defaults are going to spike. And then at that point, you're going to have fewer people paying into the portfolio. And that's where we get into the difference of dividend growth versus sustainable dividend growth, because what you want is a continued dividend payment. In fact, if you listen to the recent conference call just a few days ago, you actually hear management stating that a 13% yield is really not sustainable for a company long term. They recognize that they have to be careful in here at the rate of what some of these loans are being made. So it's really in no one's interest for this dividend to go up any more than it is. They're not going to be able to raise dividends from this point on. I mean, you're going to see these things recommended by a lot of people because 10% is a very attractive yield. But just to kind of carry this out, and if we go into a recession and things really start to tighten up, two things happen. And the other thing we haven't mentioned is credit spreads. And the simple definition of credit spread is 10-year Treasury right now yields about 3.7%. Well, I've already mentioned CCC bonds right now yield about 13.5%. So that means the spread between those two is roughly 10%. That's what we refer to as the credit spread. Well, when the economy starts to get stressed, those widen. And they can widen dramatically, especially in the higher risk debt area. And just to give you a clue of how bad it can really get, back in 2008 and 9, CCC bonds went to a yield of over 40% for a brief period of time. If that happens, the price of the bond goes down dramatically. And that leads to part of the reason why the value of these shares can get hit. And then the second thing is not only do you have that happening, but you have investors that are just panicking to get out and they're selling the shares. They can really drop dramatically. You don't want to own a BDC when this happens. The situations can really play out fast because market declines tend to be much faster than market gains over time. And you don't want to be in them to ride them down because losing 50% of your capital in market value is a lot of dividend income. And it's just not Oaktree. A couple of the other ones out there, Hercules Capital, right now it trades at a 40% premium to its net asset value. But in March of 2020, Hercules Capital got down to a discount of 66% to its asset value. And Ares Capital got as low as about 47% of its asset value. Golub Capital got down to around 58%. So the point of this is a case, great dividend, and you can get dividend growth, but you have to look at the picture, the environment that you're in as to what is going to create that. Obviously, you can compound really fast with these things. Just to give you a feel of how well these things can go, the position that I took in 2018, 5 years later, I've gotten half my money out in dividends, and the stock's gone from 13 to 20. In March in 2020, when we had pure panic, I have already gotten in just 3 years, I've gotten half the money out in dividends, plus the stock has basically doubled from what I paid for it. So it's been a very attractive investment. But this is not sustainable dividend growth. It was a great value play that paid a dividend. For these things, you really need to use discipline and you need to leave the party early, because when the market gets any hint of a problem, these things start to decline in value. So in full disclosure, possibly by the time you actually hear this, we may have sold half the position in this in Oaktree because we just don't want that much exposure in this at the moment. I think, even if I'm 2 years early selling it, we saw great value there and we've realized it. And now we don't think there's that much left in it. So it's time to exit. It's got a lot of risk built into it. Long term, dividend growth is really where your ultimate wealth comes from. Plus, it's your margin of safety. These things don't have any real margin of safety anymore because they can't raise dividends. They can't charge more than what they're already charging for their loans. Sustainable dividend growth is a long-term play, and it's a great way to create wealth. It's tied to earnings growth, it's tied to the economy, and it's tied to higher quality companies. And a BDC is not that situation. It's really that simple because they're different kinds of companies. They're not an investment that you can buy and 10 years later, you're pretty much assured that the dividend's going to be up by 100% or more. BDCs just don't have that sustainable earnings growth. But there are cases where you can buy a great income stream, but you're valuing that income stream and you're looking at the risk of it and you're treating that separately from just, this is a company that's going to continue to create value. You have to treat these investments separately from those of sustainable dividend growers. They have to take a different place in the portfolio. You can make some excellent money when you buy these things right. It's definitely worth keeping an eye on them and just, looking for opportunities. And it's pretty easy to determine the opportunities come in a recession or when credit spreads get really wide. And when those times come, these things are a great thing to add to a portfolio to really enhance yield. But you don't want to treat these things as a core part of the portfolio that you hang on for years for sustainable dividend growth. So we've talked about Oaktree extensively, and I want to stress that this is not the normal core part of our strategy, but I would like to at this point switch gears to sustainable dividend growth. So we've covered several different companies in previous episodes, and our goal is to stay accountable and to track these stories over time so that A, you get a better feel of how we execute the strategy, and B, maybe pick up some ideas of what will work for you. We've talked about Clorox, we've talked about Emerson, 3M, some of the problems there, and then also UPS, one of our recent stories. And since most of these companies virtually all of them have reported fourth quarter earnings, now's a great time to review some of the stories, what's going on, what's working, what is still a challenge. If you're curious about any of the individual stories, there will be a link in the show notes to where you can go back and listen to each one if you so choose. So Clorox was a story that in 2020, they were one of the businesses that had a huge positive impact from the whole pandemic. But the problem was business ramped up so fast, margins got a little out of control, cost of goods. They had to bring in contract manufacturing. Profit margins really declined somewhat significantly, but this has been a steady growth story over decades. And it's really been a company that's been around for close to 100 years. So where we're at on it is we think it's going to be a simple reversion to the mean, that they have the experience of managing margins. They've done it for decades and they'll get it back on track, but it's just going to take a little bit of time. The update here is that we needed profit margins to improve. And the gross margin profit in the latest quarter ending in December is showing a positive trend up now. After hitting a low of about 33% back in December of 21, the good news is now we're up to a little over 36%. So it is starting to move higher. We're expecting that to lead to the higher income, which directly feeds over into continuing to grow the dividend. But debt is flat, which is good. I'm a little disappointed in inventory. I thought they were going to get more cash out of reducing their inventory levels, but they're only down about 5%. But they did come down a little bit. So with those higher trending margins, earnings are starting to pick up. The 2023 estimate is 421. For 2024, the estimates are 535. And for 2025, the estimates are 624. Now, estimates are estimates, but Clorox is a little bit more of a dependable business. And the more important thing is, for Clorox, I hate to say this, but it comes down almost as simple as raising prices when they're able without losing market share. That's really the battle they're facing right now. But to a degree, that's what everybody else is doing too. That's why I think we've got a pretty good probability that within the next few years, they're going to get back to that norm of where they've been for decades. And right now, the dividend's $4.72. So they're roughly earning it, not quite, but they've got the free cash flow and they have some cash on the balance sheet. So if they earn $6.24 in 2025, we're back to a payout ratio that's getting back to its long-term average. And at that point, we need 5-6% earnings growth, which is basically the economy. And we're right back on track. And just another side note, when you have a dividend yield that's up a little bit over 3%, depending on which day you look at it, between 3.25%, you're at the higher end of kind of what I call the sweet spot. That 3% dividend yield buys you a little bit of time to wait for the dividend to get back on track as far as seeing growth again. When we first did this story, I will admit I was hoping that the margins would prove a little faster, but they're trending in that direction. Everything is still there for it to work. We think the long-term dividend growth there is going to be 6%. But this year and maybe even next year, I totally expect that you're probably only going to see a penny. And sometimes these things only raise the dividend by half a penny. And it's just to keep their track record. But the more sustainable dividend growth is coming out in the future if we get margins back to the norm. And if it does, it's one of those positions that you can potentially own for several decades. So now we turn to Emerson. It's another one of those businesses that's been around for a long time. They've been a great story over time, but lately it's gotten a little bit more or a lot more complicated, depending on how you want to look at it. Here you had a great dividend growth story until about 7 or 8 years ago. They sort of hit the wall. They started restructuring. They've been through a few restructurings since then. Dividends only been growing by about, some years only a half a cent a year. There was a point where you could say Emerson, if they were just tracking annual cash flow, they possibly should have cut the dividend, but they're not going to do that when they have a 63-year track record of raising the dividend every year. They're not going to give that up unless they think they're really hurting the company. And in this case, they have the resources to manage through it as long as it eventually turns. And that's what they're trying to do now. But the last time we really talked about it, this is one of the ones that I'm gonna call it, we're cautiously optimistic because they are really transforming the business to more of an asset-light model where they're getting more into data management, going more into a high-tech environment instead of their old manufacturing model. Their hope is to get more growth out of the company longer term. Yeah, they are showing some good margin growth, but pre-tax income is actually down a little bit from where it was in the last few years. The update on Emerson is they continue to transition, but here's a red flag that definitely want to keep an eye on and see how they handle this. Goodwill and intangibles make up over half the total assets of Emerson. Now, goodwill and intangible assets come from if you buy a hot dog stand for $100, but the actual cart only costs $50, so you pay a premium, that goes on your balance sheet as goodwill. Now, the theory is the person who had it before has built up a revenue stream, has built up a market, and now they're selling it to you, and they want to get paid for that. That's goodwill. This has been researched to the nth degree. The problem is basically companies that pay a big premium more times than not end up writing off a lot of that goodwill down the road because they end up just paying too much and it dilutes shareholders. Companies always have great plans when they're out making acquisitions. It's always pretty much the same story. They're going to save costs when they integrate it, or they're going to take their customers and integrate them with current customers of Emerson, and they're going to be able to cross-sell and generate more revenue from that. It may work, we'll see, but this is just a red flag. When you've got $20 billion of goodwill and you've got a total of $36 billion in total assets, it puts pressure on their ability to earn a good return on their assets. And since goodwill is such a big number, it just translates into they paid a lot for those assets. And with that, in trying to restructure or more kind of change directions, they've acquired a lot of companies and they've increased debt. Got long-term debt that's now at $8 billion. You go back 4 years, long-term debt was $4 billion. That's part of what they're using to acquire these new companies. On the good side, they've got $2 billion in cash, so they do have some liquidity. But one thing that really kind of spooks me is they're trying to acquire another company, and it's a fairly big one. It's around $7 billion. They're really going after some high growth. It's great if it works, but companies just historically tend to overpay, and that can really hurt returns on capital down the road. So they don't have a whole lot of margin of safety. If this doesn't work out so good, you can only restructure so many times, and then you're going to take a serious hit. Like I said, margins have really improved, but the balance sheet is stretched. The cash flow really isn't there yet to support long-term sustainable dividend growth. We're only looking for probably penny growth in the next few years as this thing kind of shakes out. Just recently, they raised the dividend by 0.5 cents. We're just going to have to let several more quarters go by to see whether they're going to be able to execute. So what we need to see is 2024, the earnings estimates are $4.50 a share. Historically, what the payout has been at $4.60, if they hit that in 2024, then we're pretty much back on track for 6% dividend growth. But if they struggle to get there, and depending on what that looks like, this is one that we may consider exiting out of it. Now to 3M. The 3M story is a little complicated also. The big thing here is lawsuits where the military had earplugs, that some of the military personnel are claiming that they didn't work effectively and it affected their hearing. And then also you throw in inflation. You've had issues with supply chain disruptions. So the stock is under that cloud, but you're getting paid 5% while we wait and see how this plays out. And there's all kinds of numbers out there on how bad it could be or how bad it may not be. And usually these things are not the end of the world, and you always have outlier numbers, but this is the risk in 3M right now. This one was kind of obvious. We were probably only going to get a penny raise, and that's what happened. And that's probably where we'll be for at least another year. But again, you're getting paid 5%, so it's not so important that you get 6% dividend bumps here at this point. The company's doing the responsible thing. They're not raising the dividend by much, but they're keeping their long-term track record in place and waiting to see how this lawsuit works out. Once there's clarity there, that's when we're going to see the dividend growth, unless it is really a catastrophe. But that's why you own a portfolio, and that's why you don't put too much in any one single of these things. This is a company that's been around forever, and they've in the past had a track record of being a great product development company. They've got thousands of products out there. Part of our assumption is that the lawsuit is not going to completely take them under, and B, there's still a moat there of great potential technology and product development to come down the road. Now we get to look at a story that's working out well. UPS, we've covered it. They had a huge bump a year or so ago. It was 50%. And they had been spending a lot on CapEx. They had been really focusing on making their distribution center much more efficient. I hate to do this to you, but their investments have paid dividends. What we've seen recently is, no, you're not going to get 50% dividend bumps every year, but this one just continues to work, and we're getting the growth that we need. They just bumped the dividend again from $1.52 to $1.62, and that's approximately 7%. And we continue to own it, look for any dips to add to it. So not much more to say about UPS, but it's always nice to see sustainable dividend growth play out the way you hope it does. These updates were mostly in regards to the companies that have some challenges right now. But if you remember, our model portfolio, which is a live portfolio, which has 13 companies in it right now, we've already had 9 of them that are paying more than they did last year. They bumped the dividend either in the fourth quarter of last year, or they've bumped it at the beginning of this year. Well, unless we get a cut and it's substantial, we're already guaranteed higher income this year. The key takeaway is it's a portfolio. You have to look at it that way. You have to understand what you own. You have to realize that some of them are going to be workouts while others are doing quite well. The overall portfolio is really still on track to get 6, 7, 8% growth and possibly a little higher. The point of this episode is to really look at there's dividend growth and then there's sustainable dividend growth, and that they can both go in your portfolio, but it's really these sustainable dividends that go up decade after decade. There's a lot of things you can do with your portfolio to enhance the income and grow it long term. And we looked at an investment that is not a core component of what we do, but I will use the example of Warren Buffett. He does things outside his long-term compounding that he really built his track record on. And there's always things that you can do to create value. When an investment comes up, like Oaktree, you take advantage of it. Then you also have to really pay attention to the point where when the value is realized, you need to have an exit strategy. That's what can potentially get you into trouble. So it does take a lot of discipline, just like it takes discipline to own something and let it compound. But we don't want to lose sight of the fact that we are about long-term creation of wealth, and you do that through compounding cash flow. And with that, we do want to remind you again that if you have a dividend-related question, we'd be happy to try to answer it for you. If you send us an email and we use it in one of our future podcasts, we will send you a Dividend Mailbox Yeti tumbler. So feel free to reach out. Hope you all enjoyed this episode and look forward to next month. If you enjoyed today's podcast, please leave us a review and subscribe. If you would like more information regarding dividend growth or our investment strategy, please visit growmydollar.com. There you will find previous episodes and also our monthly newsletter. If you have any questions or anything to add to today's episode, please email Ethan, ETHAN, at growmydollar.com. Past performance does not guarantee future results. Every investor should consider whether an investment strategy is right for them and all the risk involved. Stocks, including dividend stocks, are volatile and can lose money. Denweiler Capital Management may or may not have positions in the publicly traded companies mentioned herein.